Welcome to Fuller Speed Ahead. I'm Craig Fuller here with John Larkin, the legendary John Larkin, certainly a veteran of the industry. John, you've moved on from investment banking and sell-side research to now you have a new undertaking. What is?
Well, on May 17th, I had my last day as an investment banker at Stifel. Left Stifel on good terms, and on the following Monday, after a two-day hiatus over the weekend, started in at Clarendon Capital. Clarendon is up in Potomac, Maryland, and is a first-time fund that is focused exclusively on the transportation and logistics industry. However, the founding partners of Clarendon have been involved in the industry for probably the last 30 years. First as management consultants, and then they became a fundless sponsor, and did roughly 9 deals, all of which have been quite successful, with an average return of just over 5 times the initial investment, which is about double that of an average private equity fund.
That's great. What do you attribute the success of their returns from?
Well, there are 3 of us that are on the investment committee. Myself, Mark Forniciero, who is the managing partner, and then Mike Rowie. But Mike Rowie is really the investment genius, and he ultimately makes the call on all the investments and just has a really terrific eye for value and growth potential in companies, and has just done a magnificent job over the years. So we're on the committee, but we let him sort of control the vote.
Now, this is late stage or growth stage. How do you guys define stage?
Well, we're looking for companies that are looking for anywhere from a $5 to $100 million equity check. If there's a $100 million equity check involved or something in that vicinity, we would probably need co-invest from LPs or from another private equity firm. But at the end of the day, we're looking for proprietary deals in the transportation and logistics space that are a little below everyone else's radar. What we don't want to do is be the 501st guy receiving confidential information memorandum from Morgan Stanley or Goldman Sachs or Stifel, for that matter.
So non-competitive deals. Is it venture, or is it? Is it control deals, non-control deals?
It's almost always control deals. We would have several members of our team on the board, typically, going forward. There are certain situations where we would consider a minority investment, but would need to have some mechanism for clawing back control if needed, if there was some sort of failure on the part of the company or the management team.
So a couple million in EBITDA type businesses profile?
I would say 5 million and up.
Okay.
5 million to 20 is probably our sweet spot. And I was told by a number of people that there was no such thing as a proprietary deal. But after having been running around the country talking to many of my contacts, there are actually people out there who want to work with a team that understands their industry, number one. And number two, there are people that want to avoid a process. And the one thing that your new EVP of strategy and I learned when we were working together at Stifel in the investment banking world was that a full-blown sell-side managed process is very debilitating to a company. The word gets out, competitors begin to use that information against you, customers begin to get nervous, employees get nervous, some of them get cherry-picked by competitors, and it just becomes
the media picks up on it.
Media picks up on it. We had one situation where 3 companies that were supposedly involved in quiet sell-side processes were actually written about in a story that appeared in FreightWaves recently, and I had a couple of my contacts call me up and says, does that mean we're going to be written about in FreightWaves next week? And I said, no, we actually respect the NDA, and we'll keep everything quiet.
I think we have a lot of tentacles in the industry, a lot of information comes across. only 1 out of every 10 things we hear may ever get published, and really there has to be a lot of smoke around something. But that's part of transparency. It's interesting when you think about this industry, because you've been in it for many years. I won't date you, but you've been in it for a while.
Well, I'm 64, and I've never been in another industry. Let's put it that way.
This is the only thing you've done. This industry is going through transformative changes. One of it is transparency. We consider ourselves not only a contributor to that transparency, but a beneficiary of the transparency and really the development, which includes things like media commentary and talking about these topics that are often in the past sort of kept behind closed doors. And I think that's our responsibility. But I'm curious, when you think about starting a new fund and going out and raising capital and getting founders to want to sell, what is in this environment, why would they want to do that today versus perhaps 5 years ago or 10 years ago or 20 years ago?
Well, I think most of the people that we connect with who are interested in evaluating at least a transaction are people that are going through some sort of a transition in their corporation. Perhaps they would like to replace a silent partner. Perhaps they would like to replace a family that ran a company that they merged with 3 years ago. Perhaps it's a generational change within a family-owned business. It can be a financing to enable a strategic acquisition to transform the company during this accelerated phase of development across transportation and logistics. So a lot of reasons why people decide to do transactions. Another one that comes to mind is that, I know one fellow that is third generation management. He has one daughter, and she does not want to be a trucker. So he's thinking through, what do I do? I don't have an heir that wants to run the business. I probably need to monetize what I've built, what my father built, and what my grandfather built. And we can offer him kind of an interesting solution where he can still be involved and maybe roll some equity forward, but work with a group that has experience and can, in a very collaborative way, help to build the company to new heights over, say, the next 5 years.
How do you convince a founder to want to sell? I mean, I think about this often as a founder, because I always hear the horror stories, or all of a sudden you have new bosses. Now, being a venture-backed company, I have a board. Functionally, at any moment in time, the board can elect to replace me if that's what they wanted to do. My responsibility to them is to continue to do what they want me to do, which is grow the company. But I'm wondering, how do you convince someone who's been a founder, has operated the business for maybe a couple of decades, or it's a family-ran business, as you described, 3 generations, how do you get them comfortable with the thought that they're going to have new bosses all of a sudden?
Well, it's a very good question, and I would tell you that most of the people we deal with have already come to the conclusion that they should evaluate alternatives, that they need more capital. It would be financially prudent to maybe take a bite of the apple. It doesn't make sense to have 98% of my net worth tied up in an illiquid private company. I need to do that financial diversification for the benefit of my children and their children and so forth. So usually people are already thinking about alternatives, and we come in with a very interesting solution where we can work side by side with a very good entrepreneur to continue building his business and maybe transition it to professional management, or transition the management to the next generation of that family.
So the founder has to be comfortable. They're inviting you into the process.
They've got to be comfortable with us. One of the benefits of being in the industry for so many years is that I know a lot of people in the industry. They've seen me operate. They know that I'm generally an honest fellow and know a fair amount about the industry. So there's an immediate comfort there. And we connect fairly early on. There's not this mating dance, as it were. So we tend to flesh out maybe more opportunities than some others might. There's this picture of the 25-year-old Harvard MBA who, hasn't seen the light of day.
You never had to make payroll.
In the last 3 or 4 years, who shows up from New York,
Yeah.
somewhere in the middle third of the country, and usually it's tough for that person to connect with a 62-year-old operator of a transportation and logistics business.
And he's never dealt with the struggles of running a business, has never seen the cycles of the market change the way it is.
Yeah, you mentioned he's never met payroll before. Meeting payroll is a big factor. When I ran RailWorks, which was probably the most painful but the best experience of my life, we literally would send people over to the post office to bring the check received from one of our customers and deposit it into the bank almost immediately. There was no electronic deposits back then. So meeting payroll teaches you a lot of lessons.
Meeting payroll or not being able to meet it and start to, you start to make really targeted decisions on who do you push out in terms of payment. Whom are you going to talk to about, hey, you need to take a pay reduction? Those are difficult conversations, but once you go through that and survive it, there is a saying that it makes you strong. What doesn't kill you makes you stronger. I think in business and entrepreneurs, it's true.
Right. I think that's true. No, I remember we had to tighten our belt back in the fairly early going at RailWorks, and we had a senior VP of HR who was really very good at what he did, had a lot of relevant experience, was adding a lot of value to the company, but we just couldn't afford him. And I remember that he literally broke down and started crying when I went in to tell him that he's done. And it wasn't personal, wasn't a reflection on him, but it's a very difficult message to deliver when you've really got to manage expenses and more or less ensure the survivability of the company. That's the number one thing that you're responsible for.
Well, my father taught me that ultimately a company's only responsibility, the number one responsibility, is to survive. Is cash is king. Survival is the most important thing. And there are times where you're making decisions that you don't know what's going to happen at the end of the day. You don't know what tomorrow's going to look like, but you got to survive one more day. When you're burning cash, when conditions aren't good, every single decision you make now will preserve it a little bit longer. And so whether it's reducing costs, looking at pricing and how you do it, you have to make those decisions. You have to be prepared to make them, and you can't sort of get caught up in this paralysis by analysis type thing that I think a lot of private equity guys probably look at spreadsheets, and they make all the decisions in a spreadsheet, but they don't know what it's like on the front lines.
Yeah, I mean, my approach has been to visit a company, get to know the management if I don't know the management already, really try to determine whether or not they fully embrace their strategy, understand their competitive positioning, have a handle on costs, have a handle on what's happening in the technology world, where things are changing so rapidly, in part because of some of the great work that's being done here at FreightWaves. But if they're in a little silo and are insulating themselves from what the competitors are doing and what's happening in the freight tech world, then you begin to say, these folks may not be good candidates. They're going to continue to operate the business in the same manner no matter what. And in a changing world, that's a very dangerous approach.
Hey, I'm curious. Freight is going through a massive amounts of tech investment, innovation. You've got, some will say, innovators and disruptors like Uber and Convoy coming into the market, Flexport's there as well. Others say interlopers coming in to sort of take it, that they don't know, they're not from the industry, therefore they don't understand it. I'm curious, what is your opinion on what's happening right now with some of the venture capital funded companies that are coming into the space? Where does this end up?
Well, it's funny you should mention that because, as I think you know, this is Founders Camp Week here in Chattanooga, which is one of the reasons why
for Dynamo, the accelerator
I'm here. Yeah, Ted and Santosh and Barry have built this wonderful venture capital fund that, like our fund, is focused exclusively on transportation and logistics. They had roughly 20 CEOs and founders here for the week. I think they're still here meeting with strategic investors potentially. And as I talk to each one of those, they each have like a different angle on a different sector of transportation and logistics. You're not seeing the 79th guy who wants to disintermediate C.H. Robinson.
Digital broker, right?
By automating the brokerage industry. They're all solving different problems. One fellow but I sat next to you downstairs because most of the event was held at Freight Alley here at FreightWaves on the first floor of this building. He pulled out of his pocket at lunch a 20-cent device that would enable every item kind of in the world to receive messages, send messages, and also it serves as a location transponder. And his view is that nobody's been able to manufacture a device like this, but it could sort of revolutionize inventory management and transportation, especially in a high-velocity e-commerce, same-day, next-day delivery world. And there were many others. One fellow, is working on robotization for distribution centers. 10 years ago, you hired a bunch of guys, bought a bunch of forklifts, and it looked like the Indianapolis 500 in a warehouse with all the forklifts running around at high speed. And I think we're getting very close to the point at which even complex orders can be picked autonomously, and we may not even need to have lights in warehouses anymore.
Well, there are, for the largest warehouse, has warehouses in China. They run for JD.com, completely dark. There is no lights, there's no humans. It's all done by robots and drones and other types of automation equipment.
So that's a fascinating area. And, the whole autonomous truck world, I think, is a little bit overblown because of the problem associated with running an autonomous vehicle in the midst of other vehicles that are not autonomously controlled. So you literally have to model the behavior of, maybe a housewife driving a minivan with 7 screaming kids in the back.
Or a deer that runs out in the middle of nowhere.
Deer that runs out, a biker that strays out of the bike path, a guy that, had 12 beers, gets in his pickup truck and drives out in front of you. I mean, how do you model for that kind of behavior? It's very difficult, but I think intermodal yards, warehouses, ports, pieces of the infrastructure puzzle that are completely separated from unprofessional drivers.
Yeah. So I was in Rotterdam. I got the tour. They have what would be described as a semi-autonomous port. So the where the containers get unloaded, all of that's fully automatic, and they have these roving vehicles. They don't even look like trucks. They look like this weird sort of chassis that's electric that moves around there. And they said if you go behind the fence, they don't have sensors. It will run over you. It doesn't even know you're there if you're behind the fence. But they still have humans in the background that are managing the equipment and looking after it. I'm curious, when you think about the valuation, and this is a question I ask a lot of incumbent or traditional executives that have ran and exited large freight companies, some in the billions of dollars, people that you know and I know as well, when they start hearing about digital freight brokers and sort of their counter is, well, they're not doing anything I haven't done before, or they're not doing anything C.H. Robinson or Coyote or XPO hasn't done before. The question I always ask them is, do they have a problem with the business model of the digital brokers, or do they have a problem with the valuation? And it's always interesting to sort of hear their answer. I'm curious from your perspective, do you think that the digital broker's valuation, A, is earned, and B, do you think that they're transformative as much as what Silicon Valley thinks?
That's a very good question. I remember we had an event around an Orioles game in Baltimore about a year ago, and this was right after Convoy had done its most recent financing. They had raised, I want to say, like $165 million, something on that order. And one of the investors was T. Rowe Price, which also invests in more traditional brokers like C.H. Robinson and Echo and so forth. And I called Andrew Davis, who is their very fine analyst.
He's at T. Rowe Price.
He's at T. Rowe Price, and asked him what was the logic behind the investment. And he said, look, we're more or less hedging ourselves in case, in fact, C.H. Robinson and Echo and the other more traditional brokers are leapfrogged, much in the way the taxi industry was leapfrogged by Uber. We're going to be okay because we've got this hedged position. with a large ownership of Convoy, which is one of the leaders, I think, in the DFM space for sure.
Without a doubt. Yeah.
And I believe they were the first unicorn as a result of that
They were the
transaction,
first
if I'm not
digital
mistaken.
brokerage unicorn. I think Samsara and Keep Trucking may have predated them from a unicorn status as it relates to just freight. But you're correct, in the digital brokerage space. And Convoy may be the only, other than Flexport and Convoy, maybe the only two freight marketplaces that have actually achieved unicorn status.
But at this event, at the Orioles game, Andy Clark was still the CFO of C.H. Robinson at the time. He comes up to me and he goes, "Can you believe the valuation that Convoy just got on this latest round of venture capital?" And I said, "Yeah, that was really quite amazing, wasn't it?" And he goes, "You know, if you were to apply that same valuation metric to C.H. Robinson, we'd be worth like $180 billion.
Yeah.
Okay, like 10x what we're worth today." And he just thought that was really crazy. And you know, it does raise the question as to how these venture capital-based companies make the transition to the more traditional capital markets.
Do they have to? I mean, do they have to?
You know, I'm not sure they do. Certainly Uber and Lyft have, with somewhat mixed results, actually, in terms of the way their public stocks have performed. But eventually, your company has to be valued off of cash flow, earnings, EBITDA, some measure of profitability.
Tesla is not valued on cash flow. Neither is Amazon.
They aren't now, yeah. But eventually, I think you know, the bet on the part of investors in those companies today is that those companies are developing such strong market positions that ultimately they'll be able to screw down the profitability levers and really earn superior returns on capital. That's the theory, at least. But there are other companies out there. One autonomous truck company that I was just talking to that had raised $650 million of venture capital, and I was talking to some of their strategic planners, and I was amazed at how little they knew about trucking operations. Yet they're trying to autonomize the trucking industry.
Those are lottery. I mean, oftentimes the way I see those autonomous, and there's actually been some big exits in that space. Netrodyne had Nutonomy. So there's been some, not Netrodyne, sorry, but there's been some exits in that space, and they are pre-revenue. There's no revenue to speak of, but they're getting hundreds of millions of dollars. Otto, which sold to Uber, was I think $600 to $800 million exit for the investors at Otto. It's oftentimes speculative, and they're in many ways, as you mentioned, hedges. So they're lottery tickets for the venture capitalists because they don't know if it's going to succeed. They're hedges for the companies that acquire them because if they don't have an autonomous play, then the risk is that their business gets disintermediated by somebody that does. And so,
well, it's funny. When I first got involved, you know, in the early days of FreightWaves, you had mentioned that you received your initial financing from a fellow in Texas named David Hunt, very famous investor. Most of his investments, historically, the family's investments have been in the oil, drilling and exploration space, and he kind of viewed venture capital, you know, much like drilling for oil.
It's wildcatting.
And you know, you may have 5 wells that you drill today. 4 of them are going to be dry holes, but the 5th one's a gusher. And that's the same mentality you need in venture capital. So if your portfolio is diversified, and you have 100-bagger and 3 that go to 0, and 5 deals that are 3-baggers, you're probably still going to be okay.
Yeah. I think in the venture capital world, and there's astounding, because it's asymmetrical risk, is, you know, private equity, which is the world that you're operating in, and the world that, frankly, a lot of traditional investments done, is there's balanced risk and reward. In venture capital, it's all asymmetrical risk, which means the downside for them is the check size. Like, effectively, they're writing one check. The upside is exponential if that company takes off, and that's why they're willing to write a $20 million check knowing it can go to 0. In private equity or in family offices or stock, you know, you write a check, 20 million, it goes to 0. It's a big loss. That's a pretty big impact to your portfolio. But in venture, because 1 or 2 of the portfolio companies may go 100x or 1,000x, whatever, it can make the whole fund.
Right.
They only need 1.
But the fact that we have a very healthy venture capital industry in this country is what allows companies that are doing truly innovative things, like FreightWaves, like Convoy, like some of the autonomous vehicle companies, the one that's building out the hydrogen fuel cell technology. Nikola, which is building the big plant down in Phoenix. I mean, that's just totally fascinating to me. I think that's going to help define the future for sure. You don't have that kind of healthy venture capital community to the same extent in other countries, which is one of the reasons why the U.S. is such a big leader in innovation and why our economy has really been the model for the world.
It's the willingness. I hear from European startups that if they file bankruptcy, that they're ostracized. The founders, bankruptcy in Europe and parts of Asia are frowned upon because you've let people down and you're socially ostracized. Whereas in the U.S., especially in the Valley, you're celebrated because you went out and you tried. I remember the first board meeting I went to, or it was an advisor. He wasn't on the board of directors. But when I sent out our first information release, our update, investor update, he calls me and says, "We made a profit." So I was excited. We were EBITDA positive, and he says, "You screwed up." And I said, "Why?" He said, "You're making money. You just raised $3.4 million as our first round, and you aren't deploying that capital." He goes, "Craig, you don't have the guts to go out. If you don't have the guts to go out and make decisions to grow the business, then you're not the kind of investor, not the kind of portfolio company I want to be a part of." He goes, "I would be so disappointed." He used a little bit more colorful language. He goes, "I'd be so disappointed if you didn't at least attempt this." He goes, "I'd rather you burn 100% of our investment and then sell for $50 million because that means that you're really wanting to build this big business." So,
yeah, so it's a very interesting world right now that the public equity world has really become much less important. Within the capital markets, going public is a very difficult thing to do. The requirements around reporting once you are public are very expensive, very time consuming. The average CEO might spend 25% of his time on investor relations.
Well, Sarbanes-Oxley, there's the short-term thinking in the public markets.
This company was supposed to earn 25 cents in the third quarter. They only earned 24 cents. So we're going to give the company a 20% haircut on value.
Well, it's interesting you say that because like JB Hunt 360, arguably the largest digital broker out there, over $1 billion in gross revenues. If you valued it the same way you value the digital brokerage space, it's a $3 to $4 billion valued entity. JB Hunt stock has not moved since they announced that. It is basically zero value inside the stock of JB Hunt. And frankly, a lot of the analyst community have come out and talked about how they're downgrading JB Hunt stock. There was a report, I think yesterday morning or this morning, about JB Hunt got a downgrade because of their brokerage business is not going to meet the margins that they expected. There's net margin compression. So they're not getting the kind of credit they deserve if you can value the other guys at those levels.
Yeah, I mean, it takes a special kind of management team to be able to deal with the volatility that the public market dictates. You've seen stocks that go from an IPO of 12 to 24 to 2 back to 12. I mean, you're all over the place based on whether your sector is in favor, out of favor, whether the overall equity markets are in favor of out of favor, whether you've provided guidance that suggests that analyst estimates are a little bit too high. Your stock can be absolutely pulverized, which is why I think that the private equity community has really come on strong in recent years to more or less replace
it's a much more desirable place
that
to
IPO phenomenon, because typically the private equity folks have a 5-year time horizon instead of a 1-quarter time horizon, which doesn't mean that we're not going to look at performance quarter to quarter. That's very important, but it's a more forgiving look where, okay, we understand the reasons why we're a little off in the second quarter. We made some investments. We hired these 10 people to perform this function. It's all part of the strategy.
They have deep context and alignment with management, which is different than sometimes the public markets, which are
and it's just really difficult for analysts to really understand what companies are doing because of all the rules around Reg FD. Back in the day, in my early days as an analyst at Alex Brown, it was really, kind of the Wild West. If I happened to call J.B. Hunt on a Tuesday at 10 o'clock in the morning, and they had just won a big contract at 9:30, Kirk Thompson might tell me that they had just won that big contract, right. And I immediately went out with that in a report, and that was sort of my little nugget, and that was okay. It was disseminated. But not necessarily to everybody, because not everybody received our research. Once Reg FD came in, companies were a lot less willing to reveal details about their business because they can get in trouble. Yeah. They didn't like to do interviews mid-quarter with analysts for fear they would give up incremental information and have to do a press release or a SEC filing. So it's a lot less desirable to be public these days than it used to be back in the 80s, right after deregulation. Private equity has filled that void, and when you look at some of the most interesting companies out there, take a Global Trans as an example, they are really putting up some spectacular growth, being backed by very forgiving, very smart private equity folks that will give them the benefit of the doubt if they have a weak quarter once a year or so. The private equity market is just so unforgiving. Just in the last week, we've lost, 1,000 points. The public market is very unforgiving, especially if you get into a period like we're in now, with October being traditionally the weakest month. I mean, we're off 1,000 points in the last 3 days. Yeah,
but some will argue that, at least for the broader market, that there is a disconnect between the S&P and the economic activity and the financial markets, the monetary policy and trade policy, all of those things, which frankly is a lot to get into. You're going to be at FreightWaves Live, right?
Plan to be there.
November 12th and 13th.
We never miss it.
Love that. So John will be there, so will everybody else. November 12th and 13th, FreightWaves Live in Chicago. If you haven't got your tickets, get them as soon as possible. We are up 300% from last year's event, so it's going to be electric. It's going to be a lot of fun. So we'll see you there.
Yeah, for people that have not attended that event in the past, it is absolutely spectacular. Not only are all the freight tech companies there, all the cutting edge companies, but all the more traditional companies are there as well. So it's a big party with a huge amount of incremental information. It's actually my favorite event of the year to attend, and anybody who doesn't go is missing a front seat to the best show in the industry.
Well, John, thanks for coming in.
My pleasure.